Good evening, class, and welcome to our advanced taxation class for this evening. Our topic for today is tax planning, avoidance, and evasion. When we were discussing about base erosion and profit shifting, and when we were doing transfer pricing, we saw a bit about tax planning and tax avoidance. Today, we are going to discuss that concept in details. We will still be talking about some of these things we talked before, and so this particular section will not be long. So we'll be looking at tax planning. What are those things that you do in tax planning? We also, when we were discussing tax practice management, we had a little talk about tax planning. Then we'll talk about tax evasion, tax avoidance. When we compare them, then we'll talk about other tax planning issues, and we'll see advice on tax planning activities and strategies. So let's get down to business. Tax planning. The main taxes in Nigeria, we can classify them into direct taxes and indirect taxes. Which taxes are direct taxes? These are the taxes that are charged directly on the income, profit, or gain of the taxpayer. So when the income of a taxpayer is directly charged, for example, companies income tax, personal income tax, or the profits, we have petroleum profit tax, or gains, we have capital gains tax. Of course, education tax is also charged on the income of the company. So these are examples of direct taxes. Now, in direct taxes, the the taxpayer income is the taxpayer is the one that bears the burden. So it is the income of the taxpayer that is affected. Now, indirect taxes are taxes that are imposed on commodities and professional services before they reach the final consumer. So these taxes are indirect in the sense that even though the taxpayer is the one paying the VAT, and that is, let's say VAT is one of them, yes. Now, let's say a taxpayer is the one paying this VAT, but he's not paying it directly because it's not affecting his income. It is not even affecting his consumption. It is ultimately transferred to the final consumer. And so the final consumer, when he is paying these taxes, he is not even aware that he is paying it, but the person who remits it to the government is seen as the one paying the tax. But this is not his own tax, it is a tax that has been passed on to consumers, final consumers. Okay, so that is indirect taxes. Example is value added tax, custom duties. Custom duties is added to the cost of the clearing of the goods. So you will not pay it separately, you are paying it together as a cost of the goods. The same thing with VAT, the same thing with stamp duties. For example, you are registering a company and you are paying both stamp duties and the cost of registration, even though you are paying them separately, but all of them is part of the cost of the doing of business. So it is indirect taxes. Okay, so A simple guide to determining what tax is indirect is to acknowledge the fact that once the tax burden is not borne directly by the entity that remits the tax to the tax authority, then it's an indirect tax. So, like I said, VAT, if you are paying VAT, you are not the one who is paying the VAT, who is bearing the VAT. You're only the one remitting on behalf of the person who suffered it. You're just an agent collecting from those people who are final consumers. So that's indirect. Now let's go to the examples here. Look at the arrow here showing all the direct taxes here. Then we have the indirect taxes. Now, tax planning involves taking conscious effort. So I'll underline the word here, conscious effort. If you are planning, you are making conscious effort because planning is not something you do unconsciously. For example, you want to pass your exam and you are planning to to pass, you are taking conscious efforts to go to class, to attend this lecture, to practice all that you've learned, to do some other things, some other strategies. This is planning. They say, he who fails to plan is as good as planning to fail because planning takes conscious effort. So when effort is not done, it means that failure is coming. Tax planning is taking conscious effort to consider the tax that will be payable by a taxpayer at a future date and how such tax can be minimized. It could be that you're about to enter a new accounting year and you are thinking, what are the taxes I'll be paying in this new year? So you are trying to plan. Maybe your accounting year is starting from January to December, and you are in September now, and you are now thinking about the next year. You don't wait until December or January before you start thinking about the next year. You start taking it now. Okay, what are some of the things I'm going to do? What are the due dates of some of these taxes? What are some of these things that I will do to reduce the tax burden on the future period? All these are tax planning considerations. It is clear that the payment of tax is an outflow from the point of view of the taxpayer, while with respect to the profits and income, the amount that can be retained by the taxpayer from the profits of his business is reduced by the amount he has to pay as tax. So it means that the payment of taxes in any country is regulated by the laws of the country and it's a statutory obligation. So normally when you make profit, you hear people say profit before tax. If you don't pay tax, all those money that you have will become profit after tax. So now you now pay tax. The tax reduces the profit that you would have enjoyed as a risk taker, as the owner of the business. So that tax has reduced it. Even worse is the fact that some part of the profit after tax is retained as retained earnings. Let's say you are retaining 60% or 70%, and you are now paying as dividend either 40 or 30%. So the money that would have come to you has now been reduced by tax, but it is going to be something that you cannot avoid because it is a statutory obligation. Stiff penalties, including imprisonment terms, are usually in place in the tax legislation to ensure that everyone pays their tax. And so nobody will say, I don't know. Ignorance is not an excuse. So, because taxes are compulsory, uh, people have devised means to ensure that they don't pay more than the minimum tax. So you don't pay more than the minimum tax required by law. Of course, if let's give an example. If I can say that you cannot, you it's optional for you to pay your subscription, nobody will pay subscription. If I can say it is optional to pay your subscription before you write your exam, like they did in my time, we will not pay subscription until when we want to do induction, which is what I did, of course. But now ICANN is saying that, okay, before you write your exams, you must pay your subscription up to date. And so those who want to write the exam has no choice than to pay. Okay? People that have been owing for years, they have to now pay. So the same thing, if government is saying if taxes are not compulsory, they are optional, or if when you're supposed to pay it, you are free not to pay it until a certain time, people will want to take advantage of that. But now that it is done compulsorily, you must pay as at when due, then people are devising means to ensure that when they pay tax, they do two things. They pay closer to when it is due. That's one. They also ensure they pay as low as possible. Tax planning then involves anticipating circumstances and the identification of opportunities in that circumstances that will enable you to minimize your tax liability or even defer tax liability within the ambit of the law. It involves arranging your affairs to ensure that maximum allowance is achieved, maximum exemptions are obtained, maximum relief are enjoyed. Consideration will be given to the likely effect on tax liabilities on the timing of fixed asset acquisition and disposal. So sometimes the, when you are buying fixed assets and when you are disposing them, it has an effect on how much allowance you could get. You know, assets, when you buy an asset, you enjoy capital allowance. Now, let's imagine that someone who is running a January to December tax year buys an asset of, let's say, 1 million naira in January. It will be different. His capital allowance will be high compared to somebody who buys it in July. It means that even though they will have the same initial allowance, their annual allowance will be different in the sense that one of them will be used for 12 months, the other ones will be prorated for 6 months. So you can see the timing of the asset purchase of assets has enabled one company now to enjoy maximum capital allowance in that year. Then we also look at um, timing of disposal. When you dispose an asset, you only claim the capital allowances that are, you know, available up till the time it was disposed. So if you dispose it too soon, you claim a smaller capital allowance. Assuming someone disposed an asset in January, he will claim only this January capital allowance. What if he disposes it in either November or December? He will claim much more capital allowance. And much again is if you now dispose it at a cost, at a cost that is lower than your tax written down value, you stand to gain balancing allowance. Can you see that these are other things that you are considering? Now, that asset that you see that it has become obsolete. Yes, you are planning to replace it. Now, the timing when you are going to sell that asset, and you, of course, you know you are going to sell it at a residual giveaway value, and in the eyes of the law, the tax does not look at obsolescence and say, okay, revalued assets. No, it doesn't look at impairment. No, it looks at what is the tax written down value, and it rewards you appropriately when you sell lower than the tax written down value. So you see certain things here, people are taking advantage of when to dispose, when to acquire assets, and the choice of changing of accounting date. You want to change your accounting date. You know, when we're looking at changing of accounting date, we'll look at the 3 years that are involved. We'll look at the old accounting date, then we'll look at the new accounting date. And we said the tax authority will likely want to choose uh, the one that will give them the highest profit. So let's assume that you have 3 dates in mind to change from. You might do a scenario to check which one of them will likely become the best date that you will likely choose that will reduce your tax liability. All of these things are tax planning, and this is not something you can just do within a day. So, the impact of commencement rule on the legislation also have to be, decided in tax planning. When will you want to commence your business? Even when will you want to cease business? All right. Then tax planning with regard to the time that profit is earned and the timing of the payment of the applicable tax on such profits could result in financial advantage to the business. We also talk about when they are ceasing permanently. Even when you are doing merger and acquisition, the timing of the merger is also going to, play out on tax planning. We also said when we are learning merger and acquisition that instead of paying cash for shares, you can even do share for share exchange. That is also tax planning. So tax planning requires detailed knowledge of tax legislation and its application to peculiar or particular circumstances so that you take advantage of the loopholes that are in the law. That is why you see most uh, multinationals, they have detailed knowledge of tax legislation and they are ready to pay high on consultancy so that they can take advantage of these loopholes and reduce their tax very, very, very significantly. All right. Then let's look at your tax planning checklist. Now let's assume that you are about to do a tax planning. You are the tax accountant or the tax consultant for your company, and you want to do a tax planning. These are some of the things that you have to consider in your tax planning list. What are the list of approved taxes and levies? So you may need to now check, this is a limited liability company, right? What taxes are they paying to the federal government? Check them. Then, what taxes are they paying to the state government? What taxes are they paying to the local government? And we see here that in Nigeria, we have about 60 or more taxes that are levied on the taxpayer. So we need to know which of these taxes does the company are they liable to pay. So You can now look at all the taxes. You can now separate them. Okay, taxes payable to the federal government, taxes payable to the state government, taxes payable to the local government. Then the next one is timing of fixed asset acquisition. Okay, so you need to time when are you going to acquire these assets. Okay, timing of fixed asset acquisition can also apply to when you are trying to roll over and you're doing rollover relief. So you see here, if you sell an asset and you want to buy another asset of the same class, you need to do it in such a way that the 12-month period that is allowable for that will not expire, will not elapse. Timing of fixed asset acquisition is important, such that one, you increase your capital allowances, or you also do your rollover relief if you want to. So we are going to consider that. Timing of fixed asset disposal, this goes together with asset acquisition, because as you are disposing, you know that you are also going to lose some capital allowances. How much capital allowances will you want to not claim before uh, after you've lost the right or the assets? So will you want to sell your assets too soon into the financial year, or will you want to sell it very later, closer to the end of the financial year? These are considerations you will take. Timing of capital allowance claim and the amount to claim. Now, the capital allowances are also important. You know, you are taking advantage of initial allowance, um initial allowance, you also take advantage of annual allowance, then you have the investment allowance. Although in 2024 year of assessment, I think some part of this year of assessment, the investment allowance is abolished. But that's not for your exam because it's not being tested now. Now, so you need to time how much capital allowance to claim, that's fine. Then the amount to claim. Then we have hire of assets as an alternative to outright purchase. Now, if you are buying an asset, you are buying the asset, it is entering into your books, you are paying cash, and you're also claiming capital allowance, isn't it? That's fine. Now, if you hire an asset instead of buying outrightly, that is like hire purchase. Now, you're not paying the whole cash into, you're not losing all the cash at once into buying the asset. And now you have an advantage of two things. One, the higher charge is an allowable deduction. That higher charge is an allowable deduction. Then secondly, the capital allowances that you have, that you can claim capital allowances on the assets, even though legally it is not yours, but they said substance over form. The substance of the case is that you are the one enjoying the risk and reward of the asset, even though in the legal form it is not your asset because you have not fully paid, it's not in your name, but in your books it is there. You're the one that is going to claim capital allowance, you're the ones to claim all the enjoyment, you're the ones that is going to claim return on capital employed and all that. So you will be claiming capital allowance, you will be claiming higher charge as an allowable deduction. And even when you sell the asset, even before the expiration of the higher purchase, you could even claim balancing allowance. So you can see here that hire of assets might be, you know, of an advantage, tax advantage to you, even though it will make you to pay more because you are paying higher charge. That interest that you are paying, they spread the payment over 48 months, which is like how many years? 4 years. So in that 4 years that you are paying small small, that all those interest you are paying, all of them are tax deductible, and maybe the asset capital is so large that you can't pay all at once. So this is a better way. Then you also think about where to invest. Where to invest is very, very important in tax planning. For example, we have the pioneer sector. You could invest in a pioneer sector and you get to have pioneer status where you will not pay tax for at least 3 years. Isn't it good? Is it not a tax planning technique to invest in a preferred sector of the economy where the government is going to give you pioneer status? What about investing in some place where that the rural investment allowance will be obtained? For example, look at Dangote. Dangote will invest in place where there are no road. You build the road, and they will tell him take it as your tax deduction. You go to where there is no electricity, you access to electricity, you provide one, and they give you a percentage as rural investment allowance. Where to invest is very, very important. What about making specific provisions instead of general provision? So you are making specific provisions for bad and doubtful debts. Instead of saying, okay, I will just have 75% or 25% of my customers may not pay me, I'm making a general provision. No, why not specifically look at those customers that you think that will be prone to bad debts, and you make a specific provision for them instead of general. When it is specific in nature, you can allow it as an allowable deduction. So now, when you are looking at tax planning, all those things that are allowable deductions should be coming down to your head, and you'll be thinking, how can I make better use of these allowable deductions? So it means that when you are labeling your expenses in your financial reporting, you will need to now look at uh, tax allowable friendly names instead of just giving things as miscellaneous expenses, which you know that if you deduct it in your financial statement, the tax man is going to add it back. Why not give it a name that will make it allowable? Instead of saying entertainment, give it a name that will make it allowable. Payee properly deducted. When your payee are properly deducted, okay, and you have remitted the payee, it is tax allowable in the for the company. Withholding tax properly deducted, it is allowable. So you are seeing now that these are the things that you normally do in tax planning. What about critical dates? You need to know the dates for filing tax returns. Why are we going to know that? Because if, let's say for example, VAT, if you don't pay your VAT or remit your VAT on or before the 21st, of course, that means today is September 11, 9/11. So by 10 days time, if VAT is not deducted, and even though you deduct it properly, it is not filed, then you will be paying penalty. Now, when you are paying penalty, you are now paying more than the minimum, and that defeats your tax planning. So you know when the date of filing for VAT, date of filing for withholding tax, date of filing of CIT, development levy, payee, all of these, you should know them. Then that's why if you are looking at all these FRS taxes or all of these tax authorities, their calendar usually see some of these dates are being marked. So sometimes, some of these companies, they also have tax calendar. This tax calendar can help them to look at the date of filing so that they will be planning ahead. So it means that some people, when they do, what they do is that once it is the first day of the month, they start thinking, planning for the tax for their month. They'll start looking at, okay, today is the first of the month. When is the due date for all the taxes I'm going to pay for this month? They start marking them off. Or they would have marked them off by last month. And so, as at the first of this month, they are looking for that of next month and they are marking their calendars and they are now working towards it. So, filing of tax returns, the critical date is important. What about filing of notice of objection? We learned when we are doing, I think is in the last class or the class before last, we talked about notice of objection. When do we file notice of objection? It is when the tax authority has given us an assessment that we don't like, and perhaps it is different from the self-assessment that we filed. We will object to that assessment. If you don't file your notice of objection within 30 days, you are going to lose out on that objection. It means that you have taken the tax to be final and conclusive. So, failing to file within 30 days makes it invalid. Then the pay monthly remittances. Those dates for remittances of payee is important. End of year returns and final payment, that's also important. Then we look at withholding taxes, remittance. These are dates to file all of these. Then we look at capital allowance, consideration and rollover. Date is important, like we said. Okay. So capital allowance rollover, we said it when we are talking about capital allowance and other things, that when we are looking at capital allowance rollover, timing of assets, yes, it's important. Then we look at uh, stock and shares are exempted from CGT. Okay. Then we look at current tax incentives. Very good. Look at incentives that you can get. Pioneer companies, we mention it. Rural investment allowance, we mention it. Investment tax credit. Okay, these ones are applicable for the oil companies. When we get to oil and gas taxation, we'll be learning about investment tax credits. Then we also have export processing zone allowance. So there are some allowance you get for being in an export processing zone. You can take advantage of that. We have export free zone exempt profit of solid mineral mining, and we also have things like gas industry incentive, road construction and refurbishing tax scheme. Then you also consider exempt income and profit. Exempt income and profit, these are income that are exempted from tax. Income that are exempted from tax. So when you are considering, um, when you are bringing income from foreign company, when you are bringing income from foreign countries, you are bringing it through the right channel. Some of this income from dividends and income from interest are exempted from tax. Okay. Then we also have investment options. There are some investment options that will give you tax investment opportunities. There are some that are tax-free investment. Then we look at dividend distributed out of frank investment income. We said frank investment income are income exempted from the profit. So because frank investment income have suffered tax, when you are getting your dividend income, it is exempt from tax. What about distributing this income and or dividend income out of frank investment income? And we also said that whenever you are distributing your income, your dividends, the tax authority is saying that your dividends, if it is higher than your total profit for the year, your dividend becomes your total profit and can be taxed. So it means that if you're even giving out dividends, you need to also know how much dividends you are going to give out. That's why you see people giving interim dividends. Then later they give out final dividends so that they will give a small portion of it. Then when they have calculated and see what their total profit is going to be, let's say your total profit happens to be 1 million and you have given out interim dividends of 500,000, then you can as well say that since my total profit is 1 million, I have given out 500. If I give out dividends of 480 or 490, it will still be smaller than your total profit, and so you will not be taxed. So these are some things that you should know. Employees remuneration structure, considering the benefits, consider effect of benefit in kind on tax remuneration, on taxable remuneration. So when you are giving somebody benefits in kind, the company is giving you benefits in kind. They are giving you official car as against um, renting a car for you. Even both of them are tax deductible for the company, and it's going to be an income seen in the hands of the beneficiary. So it means that that big man that they are buying an official car and giving it to him, the law says that 5% of the cost of that car is added as income to the person who is enjoying the car. And it's also going to be tax deductible from the company. Now, even though they didn't buy the car, they can decide that, okay, instead of buying this car for this man that will be maintaining, we'll be looking at maintenance fees, maintenance costs. Of course, maintenance costs will still be tax deductible. They could say, okay, instead of that, let us hire a car for his use. Every day he wants to go out to take an Uber, is tax deductible too. And so they prevent themselves from, you know, buying fuel, paying for mechanic, paying for repairs and maintenance, paying for driver. Because when you buy the car, you need to hire a driver. You now decide that, okay, all of this will be served by hiring an Uber that will be taking him wherever he is. Or you have a personal driver, somebody who is having a clean car. You just say, okay, please, can you just be driving us so that I will be paying you what's your daily pay for this? And that arrangement can go. All these are tax planning. And this is benefits in kind for the director or so. And this is tax allowable for the company. So you see here that all of these are tax planning lists. So it means that if you don't have a very detailed knowledge of tax, you will not be able to advise your company on the tax planning that they should do. So of course, if a company is planning their budget, a company is planning for the new year and all that, they will come and involve everybody. They will involve the accountants, they will involve the other people. They should also involve the tax consultant, and they will tell you what is your take? And so the tax consultant will be thinking as they are saying all of this, is looking at the tax implication, tax implication, tax implication. So how do we lower your tax implication so that the maximum benefits comes to the company and less is paid in tax? Tax planning. Even as the country is undergoing some tax reforms, some companies are planning with these reforms. Did you notice when they make some withholding tax new regulations? Some companies have started adopting it, and some companies are waiting, say, let's say for October 1 or so, to start implementing. So you see, all of these, if you don't know the tax implication of every economic activity you carry on in your company, then you will not be able to do good tax planning. Now, we've talked about tax planning. Let us look at tax evasion. What is tax evasion? Tax evasion is a contravention of tax law whereby a taxable person neglects to pay the right tax by reducing his tax liability fraudulently. So it is not bad to reduce your tax liability. It is not bad. But are you reducing it appropriately? I mentioned something before. You are making some expenses and you don't know what to call these expenses. And you just say miscellaneous. You have shot yourself in the leg because by mentioning miscellaneous, the taxman is going to add it back and you are going to pay tax on it. If you have to be, if you have to claim allowable deduction on it, then you should give it a name that is allowable. So when you creatively reduce your tax by using allowable deductions, now that is not tax evasion. You are admitting that you have spent that amount and it is an allowable deduction, especially if you have documentation to show for it. For tax evasion here, you are fraudulently claiming tax returns or exemptions that are not true. So you are using illegal means, you are using fraud to deliberately reduce the tax payable to the government. Now, tax evasion can be achieved by understating income. How do people understate income? Let me tell you. Now, because you don't want to pay VAT, you don't want to pay VAT, and you go to your VAT schedule and you go to revenue where is income and you type zero, nil, and you pay VAT, nil VAT. That is not the only way to achieve nil VAT now. That is not the only way to achieve nil VAT. But when you have written revenue zero, meanwhile you made like 2 million for that year revenue, you have understated your income in your VAT. And so, forgetting that when you now file your company income tax, it is still to the same FIRS that is going to go. And they will now check your income you declared for 12 months. And they will now bring your VAT record for the same 12 months period. And they are saying that you are stating the total gross income for VAT is 500,000 and your gross income for company income tax is 24 million. There's a difference. There's a difference. So even though your company is less than 25 million and you're not supposed to pay income tax, it is possible that those undeclared income contains VAT elements. That is tax evasion. And you see, because VAT is an indirect tax, you'll be thinking that you've collected government money as an agent and you don't want to give it to them. It is not your money. They are going to come after you. They're going to come after you. It is bad enough that your income tax is revenue for your income tax is higher than that of VAT. If that of VAT is higher than that of income tax, then it's even fine. If that of VAT is higher than that of income tax, it's even fine. Than for that of income tax to be higher than that of VAT. That is understating your income. So when we are filing VAT, we should know that by what I usually say, all your income for each month which you are filing for VAT, these are the same income you tabulate and declare for income tax. They should be consistent. Then another way people understate their income is they will not declare everything. They have 3 or 4 bank accounts. One of them in Zenith Bank, the other one in GT Bank, the other one in First Bank, the other one in UBA, and the other one again in microfinance bank, like say OPay. And so, and some of them are also in business name, some are in personal name. And so some people will be paying things into their personal account, some will be paying to the business account, and you just only declare the one that is made between 8 o'clock to 4 o'clock, 8 a.m. to 4 p.m. Pay into this account. Then the next one, you are paying into another account that is not declared. And when you are now declaring your bank statement, because sometimes they will ask you to bring your bank statement, you now bring just only one and you have 4 accounts. That's understating your income. That's understating your income. So I will not tell you what to do, whether it is good for you to with to expose all your bank statements or to expose only one. But I'm only showing you that if you have income in 4 accounts and you are declaring one account, it means that you have not stated the income of the other 3 accounts, and it means your income is understated. Simple as that. The next one is overstating expenditure. How do people overstate expenditure? Okay, so they will claim that they have spent more than they have stated, they spend more than what the record is saying. Sometimes they will claim that okay, there are some expenses that um, you spend from your bank. You know, when you are making expenses from your bank, there's a trail, right? There's a trail. Now, cash expenses, you may not have trail and they are not receipted. You could claim, you could claim that you spent um, an amount higher than what you actually spent. Let's say, for example, transport. You want to spend money on transport fare. You don't, most times you don't collect receipt from transport, except you are using Uber, that you are going to be paying from your account and you can collect receipt. But if it is some other public transportation, you may not be able to track it. But of course, if you are going airline, long distance travel where they will give you receipt, even when you are entering the mass transit, or what do they call that, blue buses, these blue buses, you have your card that you can tap and you get receipt. But there are some that are not receipted. Some people take advantage of that. Ordinary basic utilities like apply like water, toilet paper. Because toilet paper, you can easily go to the market and just buy. Some people will say they don't have invoice, they don't have receipt. You can take advantage of that. And some also take advantage of the fact that they will give them a receipt, they will just write any amount on that receipt. They will just write any amount on that receipt and overstate their expenditure. So because the receipt they give them is just like an open check, that okay, give me the receipt, they will now include things that they didn't even buy and overstate their expenditure. And if these expenditures are allowable, they have overstated the allowable expenditure. And of course, The government will ask you, the tax people will ask you to show evidence that you've made those payments. You will say some of them are by cash and see the receipts. And of course, they will not take that receipt to go to the shop and go and verify. Even if you go to the shop owner is not even having a carbon copy. And so you cannot know that. So some of these things are achieved through all of this method. Then making false claims for allowance and reliefs. Making false claims. For example, you might claim that which other claim again now? We have allowances. Let's say you have we have health insurance, um, nice national health insurance scheme, pension. You might claim make false claims for all of these. But sometimes these false claims are easily detected because with the companies like you are giving, you have HMO, it can your claim can be checked. But some people still claim falsely that they have allowances. All of these things could be doctored for tax purposes. So it means that you have a health insurance of, let's say, 50,000, and you now increase it and say, oh, it's 150,000. And you know that because if you have health insurance claim, you are going to get tax relief on them, and you make false claim on them. So you find out that these are tax evasion because these are things that you didn't actually have. You have um you did just 50,000, this is my example, and you are claiming 150,000. So this is fraud. Then omission of chargeable income from tax returns. So there are some income that are chargeable to tax and you omit them. For example, you are doing your income tax, you have income from trade. You know you cannot escape that. Income from trade is there. Then you also know that income from dividend income, you may not escape that because they have collected your dividend, your withholding tax. You might not escape that. So you want to put that. Then you now omit rental income. That is what is easily omitted. Rental income. Now, why did you omit rental income? Normally, when your tenant pay you your rent, they paid you the gross. They are even supposed to charge you withholding tax. They didn't even charge you withholding tax. They paid you the gross and you didn't even remit any withholding tax to them. And because of that also, you omit mentioning that you have rent. There may be some houses you have that people know, yes, you put that. The one they don't know, you omit. This is tax evasion. So declare fully, when you don't declare fully income from all sources that are chargeable, so you are evading tax. Now, tax evasion is more prevalent when the tax system is perceived to be unfair. Now, you'll be in Nigeria and you'll be saying, what has Nigeria done for me? All they know is to use our taxpayers' money to buy private jets. All you know is that they will use our tax money to enrich themselves. Where is our hospitals? What are they doing? What have they done? They have sent their children abroad. It is not fair. The roads are not working. The rail system is not working. This is not working. And they are trying to increase VAT to 10%. Is this fair? And so, why will I be working I've been giving my hard-earned money to government. And so that is the genesis of tax evasion. And so you start thinking of ways where you will reduce by all means, legal and illegal, what is payable to the government. Lack of transparency in government may also encourage tax evasion. When government is not accountable properly, transparency is lacking. So you can encourage tax evasion. So it means that even when the tax authorities are corrupt and you know you can just settle them a small money as a kind of PRO, settle them small money and they will pocket it and they will even help you to evade tax. So you can see tax evasion is prevalent in those systems. The Revenue Service views any case of tax evasion seriously. If discovered, the revenue will go further to reopen the relevant assessment beyond the statutory period of 6 years. So when they consider that you are a tax evader, they will go beyond looking at 6 years normal audit. They may even go far beyond that, even to the time when the business was incorporated. There was a time one of a client of mine changed tax, changed tax, change of, what do I call it? He changed location. And so he was seen to be in a particular region, whereas his tax file is in another region. And so the tax authority now claimed that he's doing tax evasion. So sometimes you might not know what tax evasion that you may have committed, and when the tax authority now writes you, you'll be surprised that you think this is not serious, but they term it as tax evasion. Now, a tax evader may be charged to court for criminal offenses, which will make him to pay fine, penalties, and sometimes go to prison. Unless the amount involved is large and the taxpayer is not willing to cooperate, the revenue service will usually resort out of court settlement with a lump sum payment by the taxpayer in settlement of the tax that is owing, the penalty that would have been lost if the evasion was not discovered. So sometimes when they discover that you have evade tax and agree, they usually do not go to court. They will you now come down and tell them you arrange a payment plan. Maybe you can pay them in 3 monthly installments, or could it be 3 quarterly installments or so. So you know how you will do it. But when the taxpayer is unwilling to cooperate, then they will go to court. Now we've seen two things now. We've seen tax planning, and we've seen tax evasion and how these are being done. Let's go to tax avoidance. Tax avoidance arises in a situation where the taxpayer arranges his affairs in a form that will make him pay the least possible amount of tax. Now, tax avoidance comes with tax planning. For example, avoidance of value added tax can be achieved if we buy goods and services that are not vatable. So this one we are saying VAT increased by 10% to 10%. I usually say to people, what you can buy at supermarkets, you can buy at my 12 market. When you go and buy that fresh fish at my 12 market and it's not vatable, it's fine. But you enter the supermarket to go and buy frozen fish, and they are not charging you VAT. They are not charging you VAT. So what have you done? You have bought a vatable item. Okay, you've bought a vatable item. Even ordinary water that you are buying in a normal store, you will not pay VAT. Oya, go to a bar, go to a restaurant, go to a club to go and sit down to go and buy that same thing. They are now added VAT inside indirectly. So what is the difference between you buying it at home here and taking it and going it to the, or you just buy, instead of you to buy your chicken and prepare it at home and you buy your live chicken, no VAT, you now go to a place where they will now do barbecue for you, do pepper soup, make some spices, do everything, and you don't expect to pay VAT. So when we are buying things that are luxury in nature, we pay VAT. And so you could decide that for this coming year or this coming quarter, I will reduce my VAT payment, or I will even not pay VAT, and I will arrange my affairs so that I will not consume vatable items. Apart from boycotting the goods and services, tax avoidance schemes are carried out after a critical review of the tax law. So what happens is this: normally when a tax law is being done, let me give an example. Before the 2019 Finance Act, in commencement of business, we usually have right of election, right? Fine. And in this right of election, the taxpayer opts for the one that gives him the lowest tax. Now, you know what? Some, because of the deficiencies of this old administration, 1 year tax, 1 year income might be taxed 3 times. The income you made in the first year might undergo tax 3 times. So now imagine if you make a profit. Let's say you make a profit of 1 million, right? You make a profit of 1 million. Now that 1 million can be taxed 3 times. You end up paying 90%, sometimes 60%. But when we are looking at loss relief, that 1 million can be recorded as loss 3 times. But you find out that they will tell you the loss incurred cannot be more than the actual loss. And so your loss is being minimized. But the thing here is, some people will prefer to make a loss for the first 3 years deliberately for tax purpose, even if the loss is very small, so that they will not pay tax. And they will not be charged minimum tax because they are within their 4 years in business. So even in the first 4 years, they will want to make loss. This is tax avoidance scheme. And now, like a rat, where they will now block the hole where it used to come. Maybe it's coming from the kitchen side, they block the hole. It's going to go and discover that, okay, there's another hole in the toilet. It can come through there. You saw that hole again, you block it, you say, okay, I can come through the roof. You block it, you say, oh, I remember that place your wire used to come from your television or from your decoder. I will pass through that wire. That place is always somehow open. I will enlarge it and come in through there. So that is what tax avoidance scheme does. After a critical review of the tax law, the taxpayer would now implement the devices to exploit loopholes in the tax law that will enable him to avoid taxes or minimize his tax. So when a rat is trying to minimize his blocking out of the house, especially if it is not a church rat, it's a house rat that he knows that there is food and you are blocking him and he wants to come and eat, he look for another hole to come. So should be noted that to a very large extent, tax avoidance is legal once it is done within the ambit of the law. It is legal when it is done within the ambit of the law. However, when tax avoidance schemes are stretched to the limit, so you are doing everything possible, everything you are doing is just because of tax purpose. You want to avoid tax to all by all means. Then transaction will be seen only as a mere form and lacking substance. Um, there is there was one term that in one webinar I attended in tax, somebody called that when you stretch the tax avoidance scheme to the limit, they called it tax immorality. When you are stretching it, all your transactions is being done legally, yes, legally, you are not breaking the law when you are doing tax avoidance scheme. But sometimes morally, you are trying to avoid tax. So they call it tax morality. That was the first time I was hearing that. All right. So now all your transactions will now be seen as lacking substance. All of them are just entered for the purpose of tax avoidance. There may be no commercial effect. And when that is done, this is a red flag for the revenue and they will disallow such transactions. To the extent that no law or tax law has been contravened in several tax avoidance schemes, tax avoidance is legal. But of course, tax evasion is not legal. All right. Now look at some anti-avoidance legislation. There are two forms of anti-avoidance legislation. So this anti-avoidance legislation is being done to, reduce tax avoidance. So um, like I use the example of the rats that have exploited the topography of the house and knows where there are holes where he could run in and run out. You've blocked the hole and you don't want to be blocked out. And so you will find another hole, even dig another hole inside. So that's what tax avoidance scheme do. So now anti-avoidance could be specific. So specific legislation will be done to block known tax avoidance devices. So if like what is being done in the Finance Act 2019-2020, where they now align it in such a way that um, um, preceding year basis is the basis for charging company income tax. You find out that um, that loopholes, that you always um, take advantage of to make losses for that 3 years or so has kind of blocked. So when they make a specific legislation to address a particular loophole, like look at these tax reforms now that we are we are undergoing in the country. Some of them is being done at blocking certain things, specific things that people are doing to prevent high collection of tax or so, because we say that taxing the poor people and the rich people are getting away with it. They now make specific provisions, legislations, which they are going to propose to be passed into the law. These are specific. Then we have the general anti-avoidance legislation, which vests the revenue with the power to disregard all transactions entered into that could prove to have been entered into for tax purposes solely. So they have specific, they have general. Now, what are some of these advantages and disadvantages of specific and general? Advantages of specific anti-avoidance. Its its provision makes the law imposing tax on particular transaction clear and certain in its application. So when you are making a specific anti-avoidance provision, you are speaking directly to that particular transaction. And so everyone now knows that it is wrong to do that. Ineffective or inadequate legal legislation can readily be amended. So with specific legislation, something that is not working well, ineffective or inadequate legislation cannot be amended. What about the disadvantage? Many It may make an already complex legislation more complex and less comprehensible to taxpayer. And also, the taxpayer will be seeking further loopholes to exploit for further tax avoidance. So it may not be that particular one you've blocked, they will be looking for other holes to block. Now, what about general anti-avoidance advantages? The number of anti-avoidance legislation is reduced, consequently minimizing the complexity of the tax law. Because you are making a legislation that is broad, it will reduce addressing a specific provision. So it's just like saying that anything that is not in the VAT exempt items is vatable. That is general. So if you are thinking, is this thing I'm doing, is it vatable? All you need to do is go to the specific items list of VAT exempt item. If it is not there, then it's vatable. So you can see that specific list is like specific provision that these are VAT exempt. Now, when there is, and you now say when it is not there, it is vatable. It's like providing general. I'm just using that as an example. So when you are making a general legislation, you are reducing your specific anti-provision, anti-avoidance provision. And also, provision exists in the tax legislation to discourage all future tax avoidance. That is schemes that are considered to have violated the spirit of the tax law. So when you make your provision like that, that you are discouraged, you make provision that is seen to discourage future tax avoidance. And that is general provision. So when they now check what you are doing with the spirit of the law, which is the intent and purposes of the law, you find out that if you are doing a tax avoidance, this law is speaking directly to it. Disadvantage: provisions are general and vague and could lack precision. So sometimes it is vague because it is not specific. If you just say that everything you are doing is vatable, some people will say it to be vague. To be vague, it's just like when you want to register a business. You need to do check your specific nature of business, right? If you just come and say, I want to do buying and selling, or I want to go into oil and gas. Of course, oil and gas is an industry, but it's also vague in the sense that you may not know if it is upstream or downstream or gas utilization and all that. So sometimes they will say be specific. So when you are speaking with somebody and say, please be specific, it means the person is speaking generally and is vague in nature. So if I am to teach you tax now and I start talking generally, and you now see that I start talking and it cut across five, six, seven topics, you end up and say, sir, can you please be specific? Which topic are we teaching? That's fine. That is the same thing that happens here in tax, where you are giving a general anti-provision, anti-avoidance provision. It lacks precision. It is vague. And now too much reliance is placed on the discretion of tax officials for the application. So it means that when you are giving a vague general provision, it will not depend on the interpretation that the tax authority gives it. So sometimes the tax authority could exceed the intention of the legislation because they want you to do a certain thing. They might go above and beyond what the interpretation would be, and they will interpret it far above that, that you want to now seek interpretation from the courts. So the reliance on tax officials' discretion is another disadvantage. So now we've seen what is tax avoidance, what is tax evasion, what are the differences? One, tax avoidance is legal, tax evasion is illegal. Two, tax avoidance can be achieved through exploiting loopholes in the laws, while tax evasion can be achieved through deliberate action of fraud and deceit. Three, the result of tax avoidance is that the taxpayer pays the minimum tax without breaking the law, whereas in tax evasion, it results in the taxpayer not paying the correct tax or paying a minimum tax through the breaking of laws. Then four, tax avoidance is supported by the courts in decided cases, whereas tax evasion is not supported by the courts. And in number five, tax avoidance, there is no criminal liability. In tax evasion, you could be charged to court for criminal offenses with fines, penalties, and imprisonment. Number six, tax avoidance, when stretched to the limit, could be disregarded. In tax evasion, any limit you use tax evasion to be frowned at. Number seven, no revenue service investigation is done for tax avoidance. Prior years assessment will not be reopened, whereas that is not the case for tax evasion. All right. Now, what about other tax planning issues? We have things like thin capitalization. We said this is tax planning issues. Now, thin capitalization is when a company use up more portion of debt than equity in its capital structure. Now, while that is a tax planning, so that one, you can have interest paid very high, which is tax deductible, paid from your profits, paid from your profits before tax. You are going to pay all that and it's going to reduce your tax. It is also a planning issue on the government aspect because they are the one who are the people that is going to receive the tax. And so why is this an issue? For two reasons. One, creditors bear the risk of insolvency of the company. So when you are collecting a high loan, there is a there is a possibility of you defaulting. And when you default, there is a risk that you cannot be able to pay back the capital and interest. So you cannot be declared bankrupt, and it is going to also affect your tax liability. And it's also going to affect your going concern because of your too much gearing in your capital structure. So your the higher your gearing, the higher your chances of your business not being considered going concern. Then secondly, tax authorities are concerned about the abuse of excessive interest deduction. We saw that when we are doing transfer pricing issues. Now let's look at the credit risks. As I said before, if the shareholders have introduced only a nominal amount of paid up share capital, then the company has lower financial reserves with which to meet its obligations. The capital, the capital, the nominal paid up share capital is nominal. The company has lower financial reserves to meet its obligation if the debts are falling due. But are not when the debt is becoming high, you find out that sometimes when they are about when the debtors comes knocking. Now because looking at your financial ratio analysis and all that, you find out that your 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 gearing ratio, yes, is high. What about your profitability ratio? What about your um current ratio, your quick ratio? You find out that it is tilting towards the fact that your insolvency risk is going to be high. And so, because you are taking more credit risk, is going to affect your company. If the company fail to pay, it will go into liquidation. We see what happened to Heritage Bank. Heritage Bank went into liquidation, and this is a risk. And this is also not having it's not looking good in the economy. And so even though tax planning, I would not know whether tax planning was involved and they took some risk here, but you see the credit risk backfires and you go into liquidation. We've also talked about the tax issue where you have your allowable interest deducted at a very high rate. And sometimes because of hybrid mismatch, you might have uh, tax allowable interest here. And as you are paying this interest, is going out as a tax allowable expense. It is escaping tax. The other country or so that is receiving it The other country that is receiving it might not even be charging tax, and so it must have escaped tax two places. And so this is a tax issue. We learned all of that in your transfer pricing. And we also learned the provision of um, Finance Act 2019 on tin capitalization. We talked about tax havens. Tax havens are those states or country where certain tax are levied at a very low rate or none at all. And so individuals or corporate entities find it attractive to establish shell subsidiaries or even move themselves to areas to enjoy tax benefits. So this creates a situation of tax competition among governments, okay? And this also have um, tax implication. We learned some of the things that the OECD have done to reduce tax um, tax compliance in these places that are tax havens. And now they have decided that if you want to know a tax haven, there are three ways of knowing a tax haven. One of them is that they have nil or minimal taxes. So they might have little tax or minimal tax. Secondly, the protection of personal financial information. So they don't even go into tax treaties, because when you go into tax treaties, double taxation agreement, you will share information. But they won't go into that. They protect the personal information of the people who are within their tax jurisdiction. Then there's a lack of transparency. The lack of transparency. So it is difficult to know what is going on there because of the transparency, lack of transparency in that organization or in that places. Okay, so that's it. Examples of tax haven, most of them are in the islands. We have the Switzerland, Luxembourg, Ireland, Netherlands, um, Jersey, Isle of Man, British Overseas Territory, Bermuda, British Virgin Islands, Cayman Islands, Delaware, Puerto Rico. So these are some of the places that are called tax haven. So with this now, we have come to the end of this chapter called tax planning, tax avoidance, and tax tax planning, tax avoidance, and tax evasion. So we'll now talk briefly now on a topic called tax audit and tax investigation. Tax audit and tax investigation. All right. So let's talk about tax audit and investigation. So tax audit, what is audit? Of course, you know an audit is carried out by an auditor. And so statutory audit is an independent examination of an organization's financial record by an external auditor or auditors with a view to expressing an opinion on whether the organization is providing a fair and accurate representation of the financial position. So they are going to be looking at the accounting books, the records, the underlying records that is used to prepare the financial statement to see whether they they are following the rules set by the regulatory bodies, whether they are preparing the accounts in the right way, whether they write principles have been followed, whether there is material misstatement and all that. Now, what is the purpose of a statutory audit? One of them is to check if proper books have been kept. Then they will now look at the financial statement and see, do these financial statements agree with the books? Or are the books saying one thing, financial statement is saying another thing? Then we also have whether the requirements in the financial statement, do they agree with the application of the legislation? For example, CAMA 2020 has replaced CAMA 1990. CAMA 2020, if it has been complied with. Then we also check if applicable accounting standards, we have the IFRS and the IASs, whether they have been adhered to. Then they will now look at it whether it gives a true and fair view of the financial affairs of the enterprises. So they will now check as, is there any material misstatement? When they say material misstatement, now a figure is material if reliance on that figure can change your decision. For example, let's say um Chima is charging lecture fee here 50,000 naira per course. I say it's fine, you will pay. If Chima is charging 80,000 naira for this same course, that difference of 30,000 is material to some people. They'll say, no, how can I pay tax 80,000 naira for just advanced tax? Nah, I better use it to go and pay for all my courses and go to physical class. It's material to them. While to some people, they'll say, I like my comfort. I have the money. It's not material. So materiality is different for different companies. So when they look at the transaction, the industry, the type, and your revenue, they will now look at, is there any material misstatement? So if you are meant to write 4,500, or maybe you are supposed to write 5,400 as your expense, no, as your 4,500 as your expense. You now mistakenly write 5,400. What is the difference? 900 naira. Is it material? But if you're supposed to write 45,000 and you now write 54,000, what is the difference? 9,000. 900 might not be material. 9,000 might be material. What if that 9,000 is not material? You're supposed to write 450 and you now write 540. Difference is 90,000. Of course, that's material. It might be a misstatement, a mistake. Check it. Is it material or immaterial? That is what they will check in the audit. Now, specialized audits. Specialized audits are normally involved where special attention is needed on a special issue which is not covered in the statutory audit. So, specialized audit is a different audit where special attention is touchlighted on a particular issue. When a specialized audit is carried out, the auditor will cover in his report this particular objective that will be achieved from that audit. Okay? Now, tax audit is similar to specialized audits. This is because the statutory audit is just giving a fair and true and fair view of the tax, of the financial statements. And tax might just be a one line item. And it might not really be looked at in depthly. But now, tax audit, you are beaming the searchlight on the tax. That's one line item. That's one line item in your financial book. That this is your tax. You're now beaming the searchlight on it. This is like specialized audit. And so tax audit is looked at in that form. So how is a tax audit carried out? What are the objective of tax audits? Now, tax audits have some objectives to the tax auditor. They are going to determine whether or not adequate accounting books and record exist for the purpose of determining the taxable profits or loss of the taxpayer. So it's not just that they are looking at whether appropriate books of record are kept. Are they existing for the purpose of determining the taxable profit? They are going to also check whether or not the tax computations that has been done, those workings you did and submitted to the taxpayer, whether they agree with the underlying record. Then they are going to check if all the applicable tax legislations have been complied with. We have the company income tax C21, we have the value added tax, we also have even CAMA. They have to check if all those tax legislations have been complied with. Then other provisions could be to provide an avenue to educate taxpayers on various provisions of the law. Tax audit are also done to discourage tax evasion. So when you are accused of tax evasion, you said they are going to do audit and investigation. It is done to discourage that. It is also done to detect and correct accounting errors or mathematical errors in tax returns. So it means that that 5,400 I gave example of and that 4,500, it could be it could be that that error has been detected and the difference and all that is being done. So it is also done to give feedback to management on the various provisions of the law and to recommend possible changes. So this is applicable to the management of the FRS or so. So when they look at tax audits and they find out that there seem to be provisions of the law that people are taking advantage of most times for anti-avoidance, either specific or general, or even using for evasion, they could make recommendation for changes in that provision. They will identify cases involving tax fraud and recommend them for investigation. Plus, we recommend to the ICPC, EFCC, and all that. We learned here in when we are looking at tax appeal tribunal, we said when they are handling the tribunal cases and they see something that is criminal, they will refer it to the relevant authority. So the same thing here, when they identify cases that involve tax fraud, when they are doing investigation, the tax audit investigation, tax audit, they are going to recommend them for investigation. So there should be a difference, clear-cut difference now between audit and investigation. Even though in some tax offices, they are usually in the same floor, the same department, they will say audit and investigation. But audit is done first, investigation later. A forestall taxable person's failure to render tax returns because they know they're going to be audited. So because they know they are going to be audited and it will be found out, they will want to pay their tax and file returns. And it will forestall the taxable person from rendering inaccurate tax because they know that they are going to do audit And one of the ways, simple ways of doing audit here is you have been filing VAT now, right? Come and file your income tax and let's check the revenue you declare for VAT and the revenue you declare for income tax if they are the same. So it will prevent them from filing inaccurate returns. You want to be aligning. It will encourage voluntary compliance. It's going to encourage voluntary compliance. Now let's look at some of the differences between tax audit and tax investigation. Number one, tax audit was introduced to empower the relevant authority to conduct tax audits. Tax audit is legally required periodically to confirm the accuracy of a self-assessment returns of a taxpayer. So when you file your self-assessment returns, you file out your VAT, even though it is on Tax Pro Max, you are filing out your nil VAT, you are going to examine it. You are going to do audit. So sometimes they call it examination. It's just an audit or examination because an audit is an official examination. These days now they call it desk examination. Okay? Now they are checking the confirming the accuracy of your assessment. Sometimes you may not you may claim some allowances as allowable and they will say no, we don't agree with this, we are adding them back as disallowable. All this is done under audit, all right? Whereas in tax investigation, it is similar to other forms of investigation. It is not carried out as a routine job. It is only carried out when investigation is triggered. Audit is normal routine job. Investigation is not routine. In tax investigation, the scope of work is wider than tax audits. They are going to check in details, they are going to do more than is required in tax audit exercise. They are going to ask more questions, they're going to probe deeper, they're going to check deeper, they're going to work on your books more deeper. Now, tax investigation will be carried out only when the taxpayer is suspected to commit fraud. And how will someone commit fraud when you are doing tax evasion? So, suspected cases of tax evasion could lead to investigation. Meanwhile, we said tax audit is a routine. Even though you are complying with the tax law, there will still be tax audits to check, is there any mathematical accuracy? You could be complying with the tax law. It's just like saying now that you are writing your exams, you are following all the steps. The examiner is marking your steps. It's fine. Yes, this person is doing well, but there is a mistake in your calculation. Maybe instead of writing 9,000, you wrote 90,000 because your calculator does not have comma. Those Casio calculator that doesn't have comma, you want to write 9 million, you now wrote 90 million, and now everything now scatter. So you see, there is an audit. All right. Tax investigation is conducted by tax inspectors who have been specially trained and competent in investigation techniques. So, and they will request assistance of police investigators and enforcers if necessary. All of these are not required for tax audit. Tax audit is just a desk audit you just do in your desk. So you don't need a special training as in the case of investigation. And so the principal aim of investigation is to expose all the circumstances of fraud or tax evasion and to particularly obtain evidence for possible prosecution. So that's why for tax consultants, it will not be fine to aid and abet tax evasion. So all these things that we see that people are doing to evade tax, a tax consultant should not be found doing that. Otherwise, it could be prosecuted, the license seized, revoked, and all that. Then there should be sealing of business premises, and somebody could even go to prison. Then we have tax audit departments. But let's go to the two types of tax audit we have. We have desk audit and field audit. Now, the desk audit, also called desk review or desk examination, that's the name they call it now. Desk examination is conducted whenever a tax returns is submitted to the tax office. So as soon as you submit a tax returns, be it VAT, be it company income tax, it will be subjected to examination by a tax official, and it will be carried out on a routine basis. Now, they are going to do that to ensure completeness of the returns. They are looking out for apparent errors in your computation. They are also looking out for whether your underlying document, whether it agrees with your returns. They are also looking out to see if you are following the tax laws in the way you are computing your taxes. Now, on receipt of a desk, on receipt of a desk audit or desk review findings report from a tax office, the taxpayer should respond to the tax office within the timeline specified, or request for an extension of time to respond if it is feasible that you cannot respond in the specified manner. So normally there should be a reconciliation meetings between the tax authority and the taxpayer, and where they will now come to an appropriate consideration to what to do in the case of this tax audit, where the taxpayer is unable to provide all the necessary evidence to support the returns being audited. In the tax audit, there will be issues of additional assessment by the tax authorities. So you see here, when the tax review was done, they say supply this, supply that, supply that, supply those, and you fail to supply, they will give you an additional assessment. All right. In addition, in some cases, whenever additional information or documentary evidence is required to satisfy the DAX, the DEX audit, if they are not provided or they are not satisfactory, it may lead to the conduct of a field audit. So when they have stayed in their office to do their work remotely, provide these documents, you send it to them via email, or you come to their office and submit it to them. Most times people want to submit via email also. Everything is done remotely, no face put into it. If they are not satisfied, then it could lead to desk to field audit. Now they have left their desk and they are now going to the field. A field audit is more elaborate and comprehensive than a desk audit, and it's usually carried outside the tax office but in the taxpayer's business premises. So when the tax officers are coming to your office, no, they are coming to carry out a field audit. They need to carry out the audit in the taxpayers' premises is to enable the tax auditors to carry out the examination of applicable documents and to obtain information directly from the people who are doing the work in the business. Now, stages involved in field audits. One, they will select the taxpayers to be audited in this field audit. So they would have looked at it in the desk review and they say, okay, This person we need to visit his office. This person we need to visit his office. Now there's going to be a preliminary review of the taxpayer's file. Then there will be a notification of the taxpayer. Then there is going to be a pre-audit meeting followed by field audit. Post-audit meeting will come, interim audit review, reconciliation, and final audit report. So let's look at them one by one. So how do the taxpayer choose which tax, how do the tax authority select the taxpayers to be audited? Do they just cast lots, and or maybe they throw a dice and they say okay no, or they flip coin? No. Some of the criteria will be if the sales assessment taxpayers has not been audited in the last 2 years, it could trigger select them to be audited. Another one is claiming of excessive tax reforms, especially withholding tax. You know, withholding tax now is supposed to be used to reduce your tax. And when you are claiming withholding tax plenty, such that you not even be paying tax to the government, it calls for auditing of this company. Then sometimes you see taxpayer with nil returns, or you are continuously in a loss situation. You always find nil, 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 nil. You should come and pay your visit o. Why are you not making let's see your books. Dis one you are filing nil, let's see your books. Or you are always in a loss making situation, let's come and examine it properly. Then we check taxpayer with low adequacy ratios. For example, low profitability ratio, low what again, profitability ratio is there, um liquidity ratio. These two will make them to very low ratio, like this will make them to trigger audit. Then it could be based on industry check. You should just say they pick an industry and your company is in that industry. Then because of that, let's come and check or do a project audit on that company. It could also be based on information received from the intelligence or other FRS department. It could be that the VAT department is feeding the income tax department that look oh, this person's VAT is lower oh, this is what he declared as VAT. And now he's declaring this income as your revenue. Let's go and visit him and let him explain why. So you can see there could be also transfer pricing arrangement and other tax planning schemes. So this could be other reasons why they could select. Could be anything. Secondary files, relationship with another taxpayers by way of holding, subsidiary, related company. So it means that if they are looking out, they are auditing one company and it has related party transactions, or maybe this is a subsidiary. Because you're a subsidiary of that company, it's possible that your company too will be selected for audits. Then there's also industries group compliance, verification of poor or extraordinary performance. But they want to check your performance. Whether you make very extraordinary performance, let's come and see what happened. Or where you have brought a poor performance. Maybe the this year maybe the telecommunication industry made a particular profit margin and your own is very abysmally low. Wow, it needs to check to see what happened. Sometimes you see reference from desk audit or desk examination. So when the desk audit have referred you for examination and for field audit, it could also result in your company being chosen. Also, as a result of information from investigation of other taxpayers. So when other taxpayers are being investigated and your name come up, then it could be part of it. Then random sampling. This is where you flip your coin or you just pick. Okay, for every 10 files you bring to my table, I'll be taking the 10th file. So 1, 2, 3, 4, 5, 6, 7, 8, 9. The 10th file you pick. 1, 2, 3, 4, 5, 6, 7, 8, 9. The 10th file. This is random sampling. You just close your eye and just pick. Or they just put different taxpayers' name in a bottle. And you shake the bottle, raffle draw, you just pick. This random sampling. Then firm making unusual requests or taking extraordinary decisions such as centralizing an erstwhile decentralized operation, then also directive from higher governmental authority. All these are some of the reasons why they could pick a taxpayer for desk audit. Then we have preliminary review of the taxpayer's file. Now, this is done to prepare the audit team to know what is going to be involved in the audit task. They would like to know the basic information about the taxpayer. Who is this taxpayer? When did it start his business? What is his nature of business? What is his performance ratio? Let's highlight the risk areas so that when we are asking our questions, we'll be asking questions in that direction. So this will help them to determine the appropriate tax strategy to adopt, and which will include the audit approach, the number of days that they will need to do this audit, the technical skills that will be required to do that work, and the number of officers that will be put in that audit. Then we go to the preliminary activities. The preliminary activities could be gathering the relevant files, grouping them into audit teams. For example, if you are looking at going to a certain industries, a particular industry, you could group the files based on industries. You could even group the files based on similar risk risk um, red flags that you have. It could be similar offenses or similar errors they commit. It could be put into similar geographical region so that these things are done orderly, so they can group them in files so that people who are going to be auditing on that are going to be more productive. Then the audit teams will acquaint themselves with the background information about their cases. So they need to know background information. If it needs them doing research to get this background information, that's fine. Then they will need to prepare audit checklists to ensure that each company or each relevant areas of the audit activity will be captured. So as they are doing the audit, they are ticking the checklist to see if everything is being covered. They're going to design interview formats that will be used for the audit. Then they will now assign specific duties to the audit team. Now look at some of the audit checklists. The audit checklist need to be comprehensive to make the audit a really successful one or thorough job. The checklist is used during the audit exercise to show that a thorough job is done. So it's not enough to have a mental checklist. It is also good to have a physical checklist that will make you to cover the audit in a fast way, not in a haphazard way, in a systematic way, so that the audit is complete. It's not when you finish audit and you say, oh, when you now reach 2 days, sorry, I forgot to ask this question because there was no checklist. Now, what are some of the background information? We said the name of the company, registered address, business address. Now, what's the difference between registered address and business address? These two are different. Registered address is what you give to the CAC when you are registering the business. What you also give to the FROS when you are now filing tax is business address. So you can be asked to enter the two. Enter your registered address where you give the CAC, what is in your CAC certificate. Business address is normally what is in your receipt, what is in your invoice, where you are now operating from. Date of incorporation is different from date of commencement of business. Date of incorporation is the date on your CSE certificate. Date of commencement is the day you actually carry out commercial activity. Your tax file number, that could now be your tax promax number. Nature of business, what are you really into? Sometimes you will say your business is education. Which kind of education? You have to be specific nature of business. Your external auditors or tax consultants, if you have any of these. Your bankers and addresses, some people don't want to give their bankers because they know they are going to be called upon to bring statements, that bank statement that you are trying to hide. Some of them will not want to provide all their bankers and their addresses. Their solicitors and secretaries, some small companies do not have that. We also have share capital authorized and issued. Nowadays, there is nothing like authorized and issued separately. Both of them are the same. Then your shareholding structure, how much percentage is for equity, how many is for debt. They want to know that. Names of directors and a number of shareholders, associated companies and addresses. So which other companies are you affiliated with? So you may be in one company as a director, maybe in another company as a director, maybe in other company, as a subsidiary or as an associate. So you need to give details on that. Then litigation details, if any, if you have been litigated before. Then the period covered during the last audit or investigation exercises will need to be obtained. Then the accounting year end. All these are involved in the background information. Now, armed with that, there's going to be an analytical review of the tax returns. The officers in charge will use the following record to determine the taxpayers' performances and areas of tax audit focus. They will look at the last audit or investigation reports. Of course, there will be some recommendations, findings and recommendations. That could be an area of focus to see if the company is still doing that it was accused of or alleged to do, or the recommendation made, have they followed through it? Then look at the financial statements. Of course, they'll look at the chairman's report, director's report, auditor's report. This could be something that could give them what they will focus on. They'll look at the statement of financial position and the comprehensive income to see. They'll look at the cash flow statement and the notes to the accounts. They'll be looking at them. All these are in financial statements. Then they'll look at the tax reports, tax returns. There's going to be a spreadsheet to show the tax returns that you have prepared. Then they'll look at your financial ratios. Most of the financial ratios we look at is the liquidity ratio. They want to see how liquid you are, if you're able to meet up your obligations. We said liquidity ratio is a risk. They'll look at that. Efficiency ratio. Efficiency ratio will also check if you are using your assets effectively. Then they will look at equity position and coverage. The gearing ratio is also a tax issue to the government. We also look at profitability ratio. They will also be interested in that because without profit, you will not be able to pay tax. Then the auditor should also bear the following tax evasion tendencies in mind. They will bear in mind that people understate their income. So they will design questions to ensure that they discover that your income is not understated or it is understated. So they will ask you questions. You have provided one bank bank account. They will ask you where is the other bank account. They will just be asking you, okay, how many banks do you have? They want to see your bank record. They want to see your check. And so they want to know if you're understating your income through provision of just one bank statement, overstating of expenses, undervaluation of stock. They want to check if you're undervaluing stock. Now, how does undervaluing of stock comes in here? Now, if your stock is undervalued, your closing stock will be low. If your closing stock is low, your cost of sales will be high. If your cost of sales is high, your profit will be low and your tax will be low. I'll take it again. Your closing stock is undervalued, it is low. Now, if your closing stock is low, normally you remove closing stock when you are doing your opening stock, you add purchases, you less closing stock. If what you are lessing, which is closing stock, is low, your cost of sales, which is the result, will be high. Remember, your cost of sales is going to be deducted from your sales. If your cost of sales is high, what happens to your gross profit? Is going to be low. So that is why they need to check if your stocks are undervalued. Then if you are creating and maintaining secret reserves, they will need to check. Then post-dating sales. Post-dating sales. How do you post-date sales? You make a sales now and you post-date it to another accounting period. You will need to check. Most of the times, this post-dating sales comes between the ending of one period to the beginning of another period. Then we have outright omission of income. Okay, when you are presenting only one bank statement, that is omission of income. When you are understating your income is when you are saying that, okay, your income is 1 million, you are saying it is 600,000. That's understating. Then there is a notification of the taxpayer. When you have done all the preliminary review, then a letter will now be written to the taxpayer notifying him of the period or years that the audit will cover, the list of record or document that will be made available for the audit, and the company will be notified that this list is not exhaustive. It's possible that they can come and say, okay, let's get more document than this. The date and time of commencement of the audit, and the names of the officials who will carry out this audit. And members are expected to carry their ID cards, which should be worn at all times. Then there's going to be a pre-audit meeting. The pre-audit exercise must commence. The audit exercise must commence with a preliminary meeting with the management of the company, usually represented by the managing director or finance director, and the tax consult or the tax consultant will be in attendance. Now, the periodic meeting will be aimed at informing the taxpayer the purpose of the audit and to confirm the background information of the taxpayer that you have obtained from his file, and also getting other relevant information that are not available in the file that was submitted to them. Then they want to confirm some certain operating systems, accounting operating system used by the company, and they are going to look at other opportunities for the taxpayers to express their view on the audit. Then the actual audit will commence. After the pre-audit meeting, the revenue officers will commence their proper audit, field audit, starting with the list of records and documents to be made available to the audit. And so they will start working on it, looking at them, looking at this list, doing their work. When the proper audit has been done, there's going to be a post-audit meeting where immediately after the field audit, there's going to be a meeting between the tax auditors and the taxpayer or their representative, at the taxpayer's premises. Now, this meeting is to obtain further outstanding information or document that may only be available from the taxpayer's management and to answer some questions that arose during the field audit. Then after that, there's going to be a preliminary audit report, then interim report, then a final reconciliation meeting. After all the reports has been done, a conciliation meeting will be done with the representatives of the tax audit and the taxpayer to reconcile all outstanding issues, and the audit will now be treated in a logical conclusion. Then they will now bring their final report. When the final report is done, then additional assessments will either be raised, as well as all the disputes would have been sorted out. So this is all about the desk audit. Now let's go to the tax investigation. Tax investigation are different from audits, and they are called for when there are problems in the organization affecting the organization in a whole or segment of the organization. Such could be required when there is a large fraud suspected, or when there is evidence of mismanagement and maybe a third party blow a whistle and the tax investigation is being done. In tax investigation, the scope is wider than that of an audit, and the checking will be much more detailed. So they may carry out some things similar to field work, but it's going to be much more detailed than the field audit. Tax investigation is similar to other form of, of investigation, and it's not carried out as a routine basis. It's only done when they have committed, suspected to have committed fraud, especially tax fraud. Now, the principal aim is to expose all circumstances of tax fraud or tax evasion and obtain evidence for possible prosecution. So, in summary, tax investigation can be triggered by any of the following: failure to register for tax purpose. So, normally you register your company and you don't want to obtain TIN, but you want to be doing business. So that means you don't want to pay tax because TIN is the only way to identify your company to pay tax. You are dealing on vatable products, you don't want to obtain VAT identification number. That's a way to trigger your investigation. Normally 6 months within the date of incorporation, you should register for TIN and for VAT. Refusal to file tax returns despite persistent requests and visitation by the tax office in charge. Refusal to allow access to books and record. Abusive tax schemes or aggressive tax avoidance scheme. Now, tax avoidance scheme are legal, but when it is aggressive, when it is stretched to the limit, it's a, it may be tending towards evasion, and there may be investigation. Then suspicion of tax fraud, denial of access of tax audit exercise. So when the tax auditors come to do their field work and you deny them, you are inadvertently calling for investigation. Then regulatory authority sanction of the taxpayer. Maybe It's a publicly owned company, and so it's been sanctioned by SEC. It's uh, even CBN, if it is a banking regulation, is enough for doing tax investigation. Non-remittances of taxes collected on behalf of the tax authority, especially VAT and withholding tax. So you collect tax, VAT. VAT is not your money now, it's not part of your revenue. But because the customer paid the VAT along with your revenue, you now think it is your money. No, that extra 7.5 you added to your revenue is not yours. Simply collect your revenue and give the government theirs, and give them within 21 days of the new month, and you say no, it is your money because it came into your account. It's enough for investigation. And they said you have withholded tax. You are supposed to pay the man 100,000, and you now withhold 10%, and you're giving him 90,000. The 10% you withhold is not your money now. You're supposed to give the man, and you didn't give him, and you think now it's your money. It's a form of something that could trigger tax investigation. Now, negative tax media tax report on the company. So if there is a bad tax publicity of the company, it's enough to trigger an investigation. Then of course, if whistleblowers blew on the company, they whisper to the tax authority that look, oh, this person is evading tax, this person is doing this person is doing that, it's enough to go for an investigation. Then referrals from tax audit or law enforcement agencies. Right. So all of these, like we learned about how a tax examination, how they choose the companies to go for dex examination. So these are what could trigger a company to be investigated. Now, these are the stages of tax investigation. The first one is surveillance and pre-investigation activities. This involves checking and cross-checking, obtaining more information on the alleged tax fraud. So it means that they are checking, cross-checking, maybe it's VAT that you are not withholding, that you are not remitting. They will need to get data. They will need to get reports, complaints. It could be withholding tax, and somebody is saying XYZ company has withheld my tax. The money has withheld from me, and I'm not getting a tax withdrawing tax credits. And this has been done for 3 months now, 4 months now. And another person is also reporting, and they are now saying that so and so company has withheld tax from me, and they are not giving me withholding tax credits. It could be that because they have not filed it, they are not getting this tax withdrawal tax credit. So, do you know that when you are filing your VAT returns, when it comes to purchases, and you see no record found, could it also be that the the vendor, the person that you bought from, that you bought and you suffered input VAT, if he has remitted that he collected VAT suffered from you, if he has remitted that he collected VAT which is suffered by you, when you are now filing your own VAT, you will see the purchase record that will be making you to claim your input VAT. But if that is missing and you now went ahead and complain, look, oh, I suffered input VAT, oh, but this record is showing me no purchase record available. This is the person that I bought from. Oh, because normally when you are filing VAT, it is the people that you collected their VAT that you are putting their name and their VAT ID and all that. It is not those that you suffered VAT from. And now you are claiming that you suffered VAT, but you are not getting the input VAT to clear to knock off your output VAT, and you now give a report. So all these complaints could make a company to be investigated. Then when the this has been done and the offense has been established, then they will now notify the taxpayer. So on the completion of the surveillance, the pre-investigation activities is done. The taxpayers to be investigated be formally notified of the investigation exercise, which will now be carried on in the taxpayers' premises. The notification letter will state the period that the investigation will cover and all the documents that will be provided and the names of the officials who will do this. And of course, they need to carry their ID card. Then there's a pre-investigation meeting, which is similar to that done by the desk officers, field audit, where they will meet with the managing director or financial director, and the meeting is aimed at stating the purpose of the investigation, confirming the background information obtained during their surveillance, familiarization themselves with the company's accounting operational system, and letting the taxpayer give their their expression on the investigation. Then the eventual audit or investigation will begin. They will conduct an in-depth search or investigation in the business premises of the taxpayer, and if possible, they may want to issue a warrant of arrest to arrest any suspect that needs to be arrested. Then when they have done their search and produced some evidence that they have made some arrests, they will need to prepare a case. Then when they prepare the case and they see that they have necessary evidence to arraign the prosecutor, the when they need to arraign the defendant to court, they will now prosecute the criminal to court. But if they discover that the evidence is weak and cannot stand in court, they will not arraign the defendant to court. Then when there is a need for termination of the investigation, they will call the termination, they will call the investigation to a halt. This could be one, insufficient evidence to prosecute. Two, no criminality is involved. Maybe what was involved there was tax avoidance and not tax evasion. So they will not prosecute. Then maybe there can be termination by law where continuation can no longer be sustained under the provision of the law. Or if the suspect dies or become medically or legally insane, then the investigation will stop. Okay, so these are some of the things here we can look out in the tax investigation. So the relevant things here to look out for here is what is the difference between tax audits and tax investigation? What are the types of tax audits? We have the desk audits, we have the field audits. And how is tax audit different from tax investigation? What are the steps taken for tax audit and for tax investigation? These are some of the relevant things that will be asked in your examination. Then there is this assessment procedure after tax audit or tax investigation. If after tax audit or tax investigation, the relevant tax authority discover that any taxpayer liable to tax has been assessed as at an amount less than what he has been charged, the board, the revenue board, may within the year of assessment or within 6 years of assessment raise an additional assessment, which is also called back duty assessment. So they might go back because they find out that you you were assessed less than what you are supposed to be assessed now. It could make them go and look back. Could it be that in some prior years, that is how we've been charging you less than what you are supposed to have paid? It's just like what the electricity people usually do. When they say that your energy payment is less than what you should have been paid, they will go and start recomputing previous months, and they will now say loss of energy, loss of revenue account, and they will now start telling you that you've been not been paying the accurate or the appropriate amount for some particular years. So that's it. So they call that back duty assessment. Now, features of a back duties assessment. It it arise on a tax audit exercise where the relevant authority reviews the underlying records and confirm that the record agrees with the returns that were filed earlier. But they notice that there may be a difference sometimes between the underlying record and your assessment. And they will say this is maybe due to neglect on your part. It could be also due to ignorance. It may also be due to fraud. So whichever case, they may want to look at 6 years backward. So the back duties assessment is limited to 6 years before the year of audit. So some of the features here is looking at 6 years before the present audit. So when they discover that there is a reason for back duty assessment, they will need to look 6 years. That's why sometimes it's good to keep your financial information for even up to 6 years, sometimes even 10 years. We talked about objection and appeal procedure, so we will not talk about that much because a whole lecture was dedicated to that. We talked about all of these. Now, we talk about now power of distrain for non-payment of tax. So when a tax has become final and conclusive and a demand notice has been served on the taxpayer, and if payment is not made within the time specified, then the board may seek the power of the court to distrain the taxpayer by his goods and other charters and securities. So they will seize, that's the distrain. They will seize his goods, his securities, or his bond, or his land, or any other thing that is owned by the taxpayer, so that when they sell off these things, they will pay the tax. So now you do you see why people usually register their company as a limited company? Now it is for situations like this when a distraint is going to come. If the taxpayer is a company, it will not affect the director personal property. It's just going to only affect the company's property. But when it is not it's a limited, if not a limited company or a PLC, if it is a business name, they will go, or a partnership, they will go and even seize the personal property of the proprietor and distrade it in order to enforce compliance. So that's the power of seizure, search and seizure. So in the power of search and seizure, where the tax authority has reasonable ground to suspect that an offence involving a total or partial disclosure of information or any irregularity or offence in a connection with tax has been committed or found on the premises, registered office or other places of management of the taxpayer, the tax authority may, if necessary, file an authorization to conduct a search of that premises. Now, upon the entering the premises, the officer may seize, remove whatever is found there and that he believes may be required for the purpose of establishing wrongdoing or offence. So this search and seizure is also mainly done too in investigation. So they may obtain necessary court warrants to search and seize anything that will prove as evidence of the commission of a crime. So these are some of the things that we have learned in this chapter. We've looked at tax audit, tax investigation. We've also looked at things like back duty assessment, distrain, and so on. So this is where we will be calling it a night. We want you to look at this topic again. This is like a two-in-one topic here, and they are usually kind of interwoven. That's why they are taken together now. Although in your pack they are separated in two. The tax planning, tax evasion and tax avoidance were interwoven with other topics, and we saw it here when we discussed it. Take special note of that. Then the tax audit, tax investigation is even linking a little with this tax planning, tax avoidance, and tax evasion. So sometimes an exam question may cover either of these. So it's just like merging these two topics together as one. So they can just merge these things as one question. Maybe an A question will just be speaking on tax audit and avoidance, so tax avoidance and tax evasion. A second question might be asking about tax um audit and investigation. Who knows? And these questions might generally just be in just one question. So that's the point I was aiming at. So take your time to go through and look at all these parts that I have highlighted. These are relevant parts that could come out in your examination. So thank you so much for coming to class and making it a lively one. We'll talk about other topics in our next class. We are coming gradually to the end of this diet. So please avail yourself time for the next topic because it's going to be a very big one. It might be the one of the biggest topic we'll be taking in our tax class. So thank you so much and see you again in the next class.